Hi, today I'm going to do a quick webinar on what directors' loan accounts are and how they interact with transactions with the company during the year. So we get asked quite frequently by clients and students exactly what are directors' loan accounts, and so hopefully this will explain how they interact with the company and exactly what they are. So if we go to the desktop, this is how I would explain loan accounts just using T accounts. So we show the debits and the credits, so this all really makes sense hopefully and give you a great overview of what the director's loan account actually is. Okay, so if we're saying in this scenario we've got a director, they've set up a company and there's no transactions hitting the company at all at this stage. So we've got zero balance on the director's loan account and zero balance on all the other nominals. So our starting point is we decide to put £2,000 into our new company. So we debit the company loan account. So the asset of bank is increased. So an asset increasing is we debit the asset and then we're crediting our director's loan account. So that is effectively what a director's loan account is. We're saying we've lent the money to the company, £2,000 been lent to the company, we've got £2,000 gone into the company bank account, and we're now a creditor of the company effectively. So the director is now owed £2,000, and that's it. That is what a director's loan account is. We're now owed £2,000. So we're owed money from our company because we've introduced our own personal money into the company bank account, and that's it. So from a starting point, that is what a director's loan account is. Okay, so we've got some transactions here that we can show how the interactions happen during the year. So in January, the director decides that they're going to run a salary through the profit and loss account, so it's tax efficient to run it through. The director can get the money out, it's within his personal allowances, so he's going to get it out effectively tax free, and because it's going through the payroll scheme, it's a proper expense on the profit and loss account, so we're going to get some corporation tax relief on the salary. So we're debiting the P&L account with £1,000 salary in January. Now if that was paid out of the bank at that point, we would credit the bank account, and then that would not get transacted through the director's loan account. We're debiting P&L, director's salary, and we're crediting the bank, so we're paying the director. Now in this instance we're saying that the director has decided not to take the money. We're still running the payroll through the payroll system, so we've got £1,000 going through director's salary, and the director decides to leave it within the company to increase the working capital within the company. So we've now got £1,000 credit going against the director's loan account. So before we did that, we've got £2,000 owed to the director. At the point that the salary goes through and they decide not to take it out, we've got £1,000 going through the director's loan account. So now the director, not only has he put £2,000 into the company, he hasn't drawn out his salary. So the director is now owed £3,000 rather than the two. Okay, so that's your double entry. Debit your P&L salary, credit your director's loan account because the director hasn't taken the money out. Okay. In January, they may have also done 1,000 miles and they're operating at the current approved rate for mileage allowance of 45p a mile. So we've got £450 that's going through the business mileage on the P&L. And again, the director hasn't taken the money out. He's going to leave it in the company. He's owed it. But he's decided that he's not going to take the 458, he's going to leave it in the company. So at that point we credit the director's loan account with the £450 that he's owed for the £1,000 business miles that he's done. So at that point now the director is owed £3,450. Okay. Now in January the director decides that actually I need to live. I want to take £2,000 out of the company. So he's got these items that are crediting his loan account. So in January he goes, right, I'm going to take £2,000 out of the company because I'm owed 3,450. And so the transaction is we've got £2,000 going out the company bank account, and we're debiting the loan account. So now the director is owed 1,450. So before that transaction, the director was owed 3,450. At the point that they take the £2,000 out drawdown in January, we're now owed 1,450. Okay. So in February, then we move into February, we've done some extra business miles. So we've got another 2,000 business miles. So we're transacting in Feb. Some business mileage, £900. So we've got £900 going against your profit and loss account, and then we're crediting the loan account with £900. So again, if it was taken out at the point that we've put it through the profit and loss account, it would be crediting the company bank account. But we've decided that the director's decided he's not going to take it out, he's going to transact it through the director's loan account. So he's owed another £900. So we've got this charge going against your business mileage on your profit and loss account, and your director's loan account is getting another credit of £900. So again, before we did that transaction, we're owed 1,450. At the point that the mileage gets recorded, we're now owed 2,350. So hopefully you can see how this interacts during the year. Now in February we may say, well, we're not going to take too much out this month, we're just going to take out £500. So in February we draw down £500 out the bank account, and we can transact that through the director's loan account. So at that point, before we do that transaction, we're owed 2,350. At the point we draw down the £500, we're now owed 1,850. Okay, so it's reduced the amount that we're owed as a director. Okay, now we may also in February spend £50 on stationery that we've used our own money for, but it's the company's purchase. So at that point we're debiting stationery, so the charge is going through stationery on the P&L account, and we've used our own money. So if you'd used the company's debit card, it would just be a £50 hit in the bank account. So that would be a double entry. It would be debit stationery, credit bank. That would be it. It wouldn't be transacted through the director's loan account. But in this instance, we're saying the £50 has been spent on stationery in February, and we've paid for it with our own money. So we're crediting the loan account with another £50. So our amount owing to us is 1,850 plus the 50. So we're now owed £1,900. Okay. Then in March we decide that we're going to draw out another £1,000 for drawings for us to live. So we credit the bank account there, and then we debit our director's loan account. So at that point we're still owed £900. So you can see how all these transactions interact, and if they're going through the director's loan account, we've got this rolling total. Now if in March we decided that we wanted to draw £1,900 out, because that's what we're owed, if we draw our £1,900 out, we debit the loan account, and we're effectively now not owed any money at all. So we've all the money that we've introduced from the bank, our salary that we've put through, our mileage figures, and our stationery, we're now owed no money. We've recouped all the money that we were owed. Now you may have a scenario, and this is where the terminology overdrawn loan account comes in. So in March we may have transacted all these transactions through the director's loan account, and then we suddenly say, oh, actually I'm going to take £2,500 out of the bank, we debit our loan account. We've now got a debit figure. So we've now got this overdrawn loan account, because we're effectively saying now these transactions here add up to 4,400, and we've actually taken out £5,000. So we're effectively overdrawn by £600. So it's gone the other way now. The director now owes the company £600. So there are tax implications on doing that. And so, I'll do another webinar on close companies and loans to participators. So that's for another day. But, you've got a scenario here where, that would be an overdrawn loan account. So when you hear that terminology, that's where that would come from. So if we take that back out of the equation, we're owed £1,900. We're saying we're going to take out everything that we're owed. So we're taking out of the bank £1,900, and our loan account comes back to zero. So that hopefully gives us some idea of what the loan account actually is. There's a few transactions there that sort of hopefully explain the debits and the credits, how they interact. You've just got to be careful that if they're being transacted through the bank account and not through the director's loan account, then they won't impact on the director's loan account. So that's just something that you need to watch out for. But hopefully that's been useful, and we'll be posting sort of extra videos like this, and usability of other softwares. So if you can subscribe if you like the video, and give us a thumbs up as well. All right, thanks very much. Thanks, bye.